It's time to talk about identifying market structure and swing direction. What will this topic help you do? It will help you define your entries and trades to specific directions in the market. Now, what is market structure? So, anytime we talk about market structure, we are simply talking about how the market is trading. If it is trending to any direction or if it is consolidating, all of these are market structure. Now we have three basic market structure. If you know, we have the bullish market structure. The bullish market structure, which example is this section here. Now, the example of your bullish market structure is a market characterized by creating higher highs, higher lows, higher highs. Then we have the bearish market structure, which example is this market characterized with creating lows, lower lows, lower highs, lower lows, lower highs, lower lows. So that is your two trending market structure. And then we have the final market structure, which is a consolidation. It's a consolidation. So it's a market with a structure with similar highs and similar lows. So like this range here, we can rightly classify this one as a consolidating market because it's a range bound market trading inside a specific range, not making new highs, not making new lows. Now, how can we frame our entries, our trade direction using the market structure? Now, let's take a look at this. Let's take a look at this structure right here. Now, what do we have here? We have market shifting structure by taking out this low. And now this is shift of market structure. For some of you guys, you see this as a head and shoulder pattern. Yes, that's right. But this is shift in market structure, market breaking the previous major low. Now, what do you do when market breaks your previous major low? You no longer have to buy this market. You have to sell it. So you have to wait for retracement because it will be difficult for you to call out the bottom of this market. Now, for some, they might think, yeah, it's the support and resistance around this zone that played out. But for a fact, that's not your best frame up in this particular chart right here. Now, what do you do is, here, your major low, market took out your major low. You allow the market to retrace back above, let me say, your Fibonacci level, above 50% of your Fibonacci levels. Now, this is what I have. From what you can see in my Fibonacci, I have 70.5. This is the only area I watch in my Fibonacci level of retracement. Now, me seeing the market above 50%, I will be anticipating markets to give me a sign of further breakdown. But where I frame most of my entries is once I have any retracement up to 70% of my Fibonacci level. Now, we had this bullish structure and market breaking this bullish structure to the downside. Now, what is the characteristic of a bearish market structure? Market will create high, create low, create a lower high, create a lower low, create a lower low. Yes, so for this section, we still have this low as our major low and here as our major high because we cannot have two lows in a bearish structure. So you cannot have two lows. You cannot take two areas as two lows, lows, lows before a new low. No. So we are only going to be taking this low and taking this swing high, taking this swing low, taking this swing high. Now, if you look at what I am identifying, you see the slope that it is a down sloping structure which is your bearish market structure. Now, for some people, they will find it difficult to identify which swing areas to take to identify their structure. Now, one simple method you can do this is using your line chart. Use your line chart and identify areas of major swing as your areas of lows and highs. Areas of lows and highs. You always want to be watching out for your markets to create a low. In a bearish market, you want to see your market create a high that is lower than the previous swing high. And then you have to frame your setup toward the bearish direction, because this is where you will have impulsive move in the market. So when I talk about impulsive move in the market, I'm talking about the major move toward the direction of the trend. The major move toward the direction of the trend. So if we are in a bullish trend, this will be my impulsive move, repulsive move, or retracement. Impulsive move. Now, if you look at these moves, the retracement move, they are usually slow and they take more time. But if you are in the impulsive side of the market, your profit tends to run faster. Now, take a look at this. You see the huge candles coming to the downside. You see huge candles coming to the downside. But when you look at the candles going to the upside, you see how slow they moved. Consider this section. Aside this section, we had one big bullish candle, but consider how slow your retracement move is and how fast your impulsive move is. So you want to use market structure to frame your trade direction. First, identify your structure. Are we creating higher lows? Are we creating higher highs? Are we breaking the structure upwards? Yes. If yes, that is a bullish structure. If yes, that is a bullish structure. And in this case, you only want to frame your setup to the bullish side of the market because the trend is your friend. And if the trend is only your friend if you are trading toward the major direction of the trend. Now, we actually have micro trends. We have trends inside trends. Now, this actually is your 4 hours trend. This actually is your 4 hours trend. Now, I can actually go into a lower time frame, and you will see that this section here might have been a bullish trend in micro time frame, in smaller time frame. Let me load that. Look for that section. I'm not exactly sure I can find that right now. Okay, cool. It's here. Fine. Now look at this. What do we have here? That retracement move in the higher time frame, it traded as a micro trend in the lower time frame, with some market creating higher highs, series of higher highs and series of higher lows before the trend broke in this direction and traded to the downside. Now, if you are identifying your major market swings, you want to make sure you are doing this from a higher time frame so that you stand in the right direction that the market is trading toward in the longer time frame. So you just don't want to try to catch short movements in the market. Instead, you want to be in the higher time frame swing direction and trade toward the trend in the higher time frame. In that way, you can be able to risk small amounts of money and ride long profits. Now, there are some tools that can also support us in identifying our trends. I talked about switching to line charts. Now I'm going to talk about another tool, which is a moving average. Chart is taking time to load. Let's just wait, guys. All right, cool. We're back. All right. So your moving average is a trend following indicator. It's an indicator you use to analyze your trend, and it's also good for those who find it difficult to identify their market structure. Now I am using this particular moving average, EMA, exponential moving average, period 50. And what do I do with this? I use it to validate my bias my major trend in the market. As you can see, I'm not actually using any EMA cross also, and so instead I just have one EMA in my time frame. Depending on how fast I want it to react, I can decide to narrow it down to 21 average, but I prefer using the 50 average. Now, what do I want to see here with the moving average? Now, the moving average, once price is trading consistently above the moving average, I know that is a bullish trend, and if price is below the moving average, I know that is a bearish trend. Now, look at what we have here. If you are identifying the market with just the market structure, so you have previous swing high, and now you have a swing low, which is almost an equal low, and then markets trading above this previous swing high. Now this is what we call break of structure, BOS. Oops, can write it, BOS. And if you actually look at your moving average, at this same time we had a break of structure in your moving average, price trading above your moving average and staying above your moving average. So we find a kind of confluence here where your moving average is telling you we are now in an uptrend, and your pure price analysis is also telling you we are now in an uptrend. Now, for you to actually validate your trend, you want to see price distance itself away from the moving average as your trend identifying indicator. Now, if your price is actually far from your moving average, you know we are in a strong trend, either bullish or bearish. But if your price is moving back toward the moving average, that is a retracement move. If it trades below it and distance itself, yes, that is also a bearish move. Now, using the moving average is actually a lagging method of you trying to identify your trend, trying to join in the trend. But for a beginner, it will help you to stay in the right direction of the market. So if price is above your moving average, you want to look for buy positions. If price is below your moving average, you want to look for sell positions. That is how you use your moving average as a trend following indicator. I wouldn't recommend you trying to use different strategies like EMA crosses, this, that. I actually don't use them, but I actually use the moving average to identify for new students to like get a right bias of the market and trade toward the right direction of the market. So I don't want to see my students actually trading a market that is below the moving average and distance away from the moving average without breaking any structure to the upside. I don't want to see my students trading long positions in such markets. I don't want to see them trading long positions in such market, because that's going to be detrimental, because they will keep buying, stacking up positions that will continue running against them if they do not know the bias that they are supposed to stick with in the market. Now, when you see price dancing around your moving average like this can kind of be a boring market if your profit target is not a close one. So for the three basic structures, they are somewhat like this. For your bullish market structure, your moving average is going to be below price. For your bearish market structure, your moving average is going to be above price. This is going to be your moving average. And then for your consolidating market structure, your moving average is going to be in between price, just like what we have here. So you see this zone, you can easily identify it as a consolidation zone using your moving average. And here you see price trade below the moving average, come back for a retest below the moving average. Now, once you are able to master this, you'll be able to trade toward the right direction of the market, the long-term direction of the market. You'll be able to maximize point profit. Now, there are different ways you can actually pick your entries. You might be a trend line trader, this, that. I'm not going to be diving into that in this particular video, but my bottom line is trying to teach you how to trade to the right direction of the market. So if you are a cryptocurrency trader and you hear people saying buy the dip, but you check your charts and you're seeing maybe your price trading consistently below your moving average, if you are not going to be doing that for the long term, that's not the right time for you to buy the dip. That's not the right time for you to buy the dip. Instead, you want to see strong evidence that price is acting strong and is ready to trade toward the upside. Now let me quickly review the mathematics. I'll not go over mathematics about the moving average, but let me quickly review what the moving average does. Now this moving average, it's actually average price. So right now I have 50 period moving average. So what this 50 period moving average will calculate for me is average of every 50 candles, and right now I am in 1 hour time frame, so average of every 50 candles times 1, which is average of every 50 hours, which is approximately 2 days. Now the information you can derive from your moving average is this. Right now this is the average price of the last 2 days. At this moment, this was the average price of the last 2 days. So it simply means if you are buying around this top, you are buying at an inflated price. So price is inflated once it is above your moving average, and price is deflated once it is below your moving average. Now, irrespective of your bias, if you want to go bullish or bearish, you want to try as much as possible to buy close to the average of the market. Now, how do I mean? Look at a section like this. Look at a section like this. Market is always going to pull back. Now we have markets breaking below our moving average, coming back, and now don't just frame your strategies around the moving average. Look at what we have here. We have previous high, and then markets swinging low, creating this low, and then creating a swing failure. So you can see market failed to make a new higher high to continue a bullish run, and in this case it also broke below your moving average. Now what you want to do is if you could not find a frame up in your lower time frame, pull back to a higher time frame region, let's say a higher time frame supports, a higher time frame, anything that you use to frame your entry. If you could not find an entry around that level, now what you want to do is wait for market to pull back close to your moving average and find a key swing high. Now look at this, market pulling back to my moving average, and I have a key swing high here. What I'm going to do is to frame my setup, my entry setup around this area of the moving average, and putting my stop loss above this previous swing high, because in a bearish run I don't expect market to swing above previous high, and if it does, this might signal a change of structure. So you want to wait for pullback to your moving average and find previous structure and frame your setup around this, just like I just explained here. You can see the same phenomenon reoccurring here, market pulling back to your moving average and you having a swing point around this zone. You might want to also pick this, but let's just stick with this. You have a swing point around this zone, so you frame your setup, and this is a very wide risk section, so you might want to navigate to a lower time frame to pick a better swing, a lower swing point, an area you can frame in lower risk entry. If you take a look at this, you see markets creating this. Actually there is an RSI divergence here, but I'm not talking about that in this specific video. So you see market creating a similar low, something like a double bottom, which is a bullish pattern. Now outside from creating something like a similar low, you also see market breaking to the upside, and distancing itself from the moving average. This you want to take note of. So if market actually crosses your moving average and is trading around the moving average, that means the expected trade is not a powerful one. So you want to see market pull away from your moving average before you validate the trend as a legit trend. You want to look for retracements to actually join. Now yes, you see your market creating something like a double bottom and breaking your structure to the upside, giving you a break of structure to the upside. And if you are actually in a higher time frame, you are going to see this is your major swing high instead of identifying microstructures, and here is your next major swing low. So in a higher time frame, our market structure is like this. Here as our low, swings to this point, pullbacks, retraces, and you see retraces to around and slightly below your moving average. Now the information here is just like I said, you want to make sure you are buying an inflated market around the average price. You're not going to be seeing it in much of a discounted price if the trend is strong, but at least you want to make sure you are buying at around an average price, because in a bullish market, price tends to move back to average and back up to premium. So you want to make sure you are buying pullbacks. You are buying pullbacks, not just buying when price is highly inflated. There are different ways you can measure your pullback. You can use your Fibonacci tool, use this, that, so and so. Yeah. So basically, you can let me review that again. You can use your line charts to identify your swing points, your major swing points as your market structure, and you only want to trade towards the direction of the structure. So if market is giving you higher highs, higher lows, from what you can see here, higher highs, you know that this market is bullish and you want to frame your setup around bullish part of the market. You look for an entry and then you frame your setup to the upside of the market. If your market is bearish, you do the same thing. You look for a setup around your bearish market structure. So I hope this adds value to your trading. Go into your chart, try to implement this and analyze and test it in your demonstration trading and see how you can apply this to your trading. Goodbye for now. See you another day.